You know, China's economy is one of the biggest paradoxes out there. For the last 40 years, it's had this absolutely explosive growth, the fastest in human history, really, lifting 800 million people out of poverty. But then you look at its stock market, and for 2 whole decades, it's been a complete ghost town. How is that even possible? Well, in this explainer, we're going to unravel that exact mystery.
Okay, so to really get this, we have to start with the most basic question that trips everyone up. If China is run by the Communist Party, how on earth can it have a stock market, private companies, and yeah, even billionaires? It just doesn't seem to add up. But the answer to that question, it pretty much reveals everything about how their entire system really works.
So to get to the bottom of this, we first got to tackle a massive misconception, especially here in the West. It's this idea that China just sort of gave up on socialism and went full-on capitalist. The reality, though, is way more interesting than that.
Now, the moment this whole myth really takes off is back in 1978. Mao had just died, and the new leader, Deng Xiaoping, launches this famous policy called reform and opening up. And that's the exact moment that so many people look at and say, see, that's when they became capitalists.
But, and this is a huge but, that view is just way too simple. Deng wasn't throwing socialism out the window, not at all. He saw market forces as a tool, a really powerful engine he could use to build up China's industry and pull his people out of poverty. He actually believed that his socialist system could use these tools to outperform capitalism.
So, if it's not pure capitalism, what is it? Well, the official name for it is socialism with Chinese characteristics, and it's all built around one single core principle. The state stays in powerful control of the most important parts of the economy, period. There's this fantastic analogy that helps explain this called the birdcage economy. It came from another big leader at the time, Chen Yun, and the idea is super simple. Think of the market as a bird. You let it fly around, you let it be dynamic, you let it do its thing, but it always has to stay inside a cage controlled by the state. Now, the state can make that cage bigger or smaller, but the bird never, ever gets let out.
And what does that look like in the real world? Well, state-owned companies, or SOEs, they generate about 1/3 of China's entire economic output. Now, you might be thinking, hey, that means the private sector is bigger. And you're right, it is. But 1/3 is still a massive, massive chunk for the government to be running directly, way more than you'd ever see in a Western country.
And here is the really crucial part. That state control isn't just random. It's super strategic. It's focused on what they call the commanding heights of the economy. Think of it like the country's main control panel. All the big banks, the entire energy grid, all the telecommunications, heavy industry. These are the levers that the state can pull anytime it wants to steer the whole ship.
So because of this state-led model, China's economy is basically playing a completely different game than the United States. It's got a different rule book and honestly, a totally different idea of what it means to win. Let's really break down that core difference.
And this right here, this slide just nails the fundamental divide in philosophy. In China, the market is a tool the state uses to achieve its goals, like developing the nation. In the U.S. system, it's often the other way around. The state is a tool used to help the market work better for private companies and their investors. The roles are completely, totally flipped.
And this difference in what they prioritize has this just stunning effect on the stock market. Get this. For 2 decades, while China's economy was absolutely booming, its main stock index, the CSI 500, went almost nowhere. It's just been completely flat, stagnant. Now, compare that to the US S&P 500. Over that same period, it absolutely exploded in value. And this really shows you the difference, right, in the American system. How the stock market is doing is often seen as the #1 sign of how the whole economy is doing.
A 100-fold increase in the real economy, the GDP, while the stock market flatlined. This is probably the clearest piece of evidence you will ever see that in China's model, the stock market and the real economy are just fundamentally separate things. The stock market just isn't the main event. So, if the goal isn't just to pump up the stock market, then what is the goal? Let's dig into the real-world results of these totally different priorities and ask a pretty simple question. Who is each system actually designed to benefit? You know, it's funny, even Western financial analysts are finally starting to realize that China isn't playing by the same rules. Like this one analyst said, the state's goal isn't rent extraction, which is just a fancy way of saying using a powerful position to squeeze out profits for investors. Instead, the whole stated goal is something they call common prosperity. And you can see this difference really clearly when you look at how companies get money to grow.
In the US, you want to expand your company? You go to Wall Street, you sell stock. Simple. But in China, pretty much everyone, private companies included, gets their capital by borrowing from the country's gigantic, state-owned banks. And that's a game changer, because it means the state, not the market, is the one directing where the big money flows.
So when you have a system that is laser-focused on boosting stock prices, who's actually winning? Well, the numbers are pretty shocking. In the United States, the richest 10% of people own a record 93% of all stocks, and the entire bottom half of the country, they own just 1%.
At the end of the day, it all comes down to a consistent pattern of choices in China's economic policy. It favors labor over capital. It favors building real stuff, industrialization, over just making money with money, or financialization. And it prioritizes creating public goods over letting private interests find ways to extract rent.
All of this leaves us with a massive question for the 21st century. What you have here are two economic superpowers, basically running on two completely different operating systems. One puts the market and financial returns first, the other puts the state and industrial development first. So as these two giants continue to compete on the world stage, the question we all have to ask is, which of these models is actually built to last?